In today's video, we'll delve into NVIDIA's recent stock split and what it means for investors. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. NVIDIA recently made headlines by announcing a 10-for-1 stock split. This move aims to lower the price of each individual share, making it more accessible to a broader range of investors. For months, there was speculation about whether NVIDIA would take this step, especially as its stock price approached $1,000. This week, NVIDIA confirmed the split following its earnings report, sending the share price to nearly $1,000 before the split. Post-split, NVIDIA's shares will trade at a much lower price, though the company's market value will remain unchanged at $2.3 trillion. So what exactly is a stock split? In simple terms, it means issuing more shares to current shareholders, reducing the price of each share without changing the overall value of their holdings. For example, if you own 1 share of NVIDIA today, after the split, you will own 10 shares. But the total value of your investment remains the same. The primary motivation behind NVIDIA's decision is to make its stock more accessible to investors who might have been hesitant to buy shares at such a high price. NVIDIA has a history of stock splits, having completed 5 over the past 24 years. Each time, the stock price was significantly lower than it is today. This move is not surprising given NVIDIA's phenomenal growth in recent years. But the key question remains, is it the right time to buy NVIDIA shares? Let's explore NVIDIA's performance and future prospects to answer that question. NVIDIA's recent earnings report paints a positive picture. The company reported triple-digit growth in revenue and net income for the first quarter of fiscal 2025, with revenue reaching record levels. Their gross margin has also widened to over 78%, highlighting increasing profitability. This growth is driven by the surging demand for NVIDIA's products, particularly in the AI market. NVIDIA's upcoming Blackwell architecture and its most powerful chip yet promise to keep demand high. The AI market itself is expected to grow significantly, with analysts predicting it could reach over $1 trillion by the end of the decade. NVIDIA, being a leader in this space, is well positioned to benefit from this growth. This optimism is reflected in the company's forward earnings estimates, where NVIDIA trades at about 34 times forward earnings, a reasonable figure considering its long-term prospects. Now let's dive deeper into NVIDIA's market position, products, and what makes it a compelling buy. Number 1. Data center revenue growth. NVIDIA's primary products, graphics processing units, GPUs, are essential for complex computing tasks such as AI model training. Over the past year, the demand for AI has skyrocketed, pushing NVIDIA's stock to new heights. In the first quarter of fiscal 2025, NVIDIA's data center division, which includes revenue from AI GPUs, saw a 427% year-over-year increase. Even more telling is the quarter-over-quarter growth rate, with a 23% increase from the previous quarter. This shows that AI demand is not just high but continually growing. NVIDIA expects its second quarter revenue to be around $28 billion, reflecting a 107% year-over-year growth and an 8% quarter-over-quarter increase. Despite these impressive figures, NVIDIA has consistently outperformed its guidance, indicating strong business momentum. Number 2. Stock valuation. One reason some investors have been hesitant to buy NVIDIA stock is its high valuation. Before the first quarter results were announced, NVIDIA was trading at 35 times forward earnings. To put this in perspective, Microsoft, another tech giant, trades at 36 times forward earnings. Given NVIDIA's rapid growth, this valuation appears justified. When a company is transforming an industry as NVIDIA is with AI, traditional valuation metrics can sometimes be less relevant. Number 3. Dividend growth. NVIDIA recently announced a 150% increase in its dividend. While the previous dividend yield was minimal, this increase is a positive signal for future growth. The company now pays a cent per share quarterly dividend post-split, representing a 0.04% yield. Although this might seem insignificant, it sets the stage for potential future increases. NVIDIA's focus remains on reinvesting its cash flows to drive further business growth, rather than paying out large dividends. NVIDIA's consistent innovation and leadership in the AI space make it a strong candidate for long-term investment. The company's decision to split its stock, while primarily cosmetic, could help attract more investors by lowering the price per share. However, the real reasons to invest in NVIDIA go beyond the stock split. They lie in the company's robust financial performance, market leadership, and future growth prospects. NVIDIA has firmly established itself as a powerhouse in the tech industry, especially in AI, gaming, and data centers. Their GPUs are famous for their high performance and efficiency, making them the go-to choice for many applications. Let's talk about gaming first. NVIDIA's GPUs are a staple in the gaming world, providing top-notch graphics and smooth gameplay. Their GeForce series is a hit among gamers, offering options that cater to both budget-conscious users and those looking for high-end performance. As the gaming industry keeps growing, fueled by advancements in virtual reality and the rising popularity of esports, NVIDIA continues to thrive. But before we proceed, here's a question for you. Do you think NVIDIA's stock split will attract more investors, or is it just a cosmetic move? Comment your thoughts below. Now, shifting to AI and data centers, NVIDIA's GPUs play a crucial role here as well. These GPUs are built to handle the heavy lifting required for training AI models and running large-scale data centers. It's no surprise that NVIDIA's data center business is booming, with revenues skyrocketing year over year. This trend is set to continue as more companies pour investments into AI and cloud computing technologies. But that's not all. NVIDIA is also making significant moves in the automotive industry with its Drive platform, which offers AI-powered solutions for autonomous vehicles. This innovative platform integrates hardware and software to enable self-driving capabilities, painting a bright future for the automotive sector. So, whether it's gaming, AI, data centers, or even autonomous vehicles, NVIDIA is at the forefront, driving innovation and growth across multiple industries. Investing in NVIDIA comes with its share of pros and cons. On the plus side, NVIDIA has a strong market position as a leader in the GPU market, with a solid foothold in gaming, AI, and data centers. This diversified portfolio not only helps spread the risk but also ensures steady revenue streams. Another major advantage is NVIDIA's heavy investment in research and development. They're always pushing the envelope in technology, which keeps them at the forefront of the industry. The growth potential is another big win. The AI market is poised to explode, and NVIDIA is perfectly positioned to ride this wave. Their products are crucial for AI development, making them a key player in this rapidly growing market. Plus, NVIDIA's strong financial performance with significant revenue and profit growth underscores their ability to generate value for shareholders. Their increasing gross margin highlights just how profitable they are becoming. However, there are some downsides to consider. For starters, NVIDIA's stock isn't cheap. It trades at a high multiple compared to some of its peers. While their growth prospects justify this to some extent, it does pose a risk for investors looking for quick returns. The tech industry is notoriously volatile, and NVIDIA's stock is no exception. Investors need to be ready for potential ups and downs in the stock price. Competition is another challenge. NVIDIA faces stiff competition from companies like AMD and Intel, which are also making big moves in AI and GPU technologies. This could impact NVIDIA's market share and profitability. Lastly, as a global company, NVIDIA is subject to various regulations and trade policies, which can affect their operations and financial performance. So while NVIDIA offers some great opportunities, it's important to weigh these against the potential risk. Examining NVIDIA's recent performance and market position, we see a robust growth trajectory fueled by its leadership in AI, data centers, and gaming. The recent 10-for-1 stock split makes NVIDIA more accessible, aiming to attract a broader investor base. NVIDIA's impressive Q1 fiscal 2025 results, with triple-digit revenue growth and an expanding gross margin, highlight its profitability. The company's innovative Blackwell architecture and upcoming powerful chips promise sustained high demand. NVIDIA's significant role in the booming AI market, expected to surpass $1 trillion by the decade's end, underscores its long-term growth potential. Despite a high valuation, NVIDIA's consistent innovation, market leadership, and strong financial performance make it a compelling investment. In summary, NVIDIA's 10-for-1 stock split makes its shares more accessible to a wider range of investors. The company's impressive growth in revenue and profitability, coupled with its leadership in the booming AI market, make it a compelling investment opportunity. While the stock split might trigger a short-term run-up in the share price, NVIDIA's long-term growth prospects are the true drivers of its value. If you're considering investing in NVIDIA, now might be a good time, whether before or after the stock split. The company's fundamentals are strong, and its future looks promising. As we wrap up, we'd love to hear from you. How do you think NVIDIA's growth in the AI market will impact its long-term stock performance? Comment your thoughts below. Thank you for watching Simple Investing Secrets. If you enjoyed this video, please like and subscribe to our channel for more valuable insights and updates. Remember, this video is for informational purposes only and does not constitute financial advice. Always do your own research before making any investment decisions.